Okay, welcome to session 10, part A. In this session, I'm going to concentrate on chapter 7, chapter on profit and loss. Actually, session 11 is I've reserved to also go after chapter 7, although I don't think there's that much substance in chapter 7. I'm not sure I did that right, if I should have devoted 2 sessions. So it looks like what I'm going to do is this session will be abbreviated. It'll be shorter than usual. And almost surely session 11 will too. Good chance I may substitute something for session 11. We have a midterm coming up. Maybe we can do something like do a little review, or I'll probably want you guys to do a practice exam, so maybe I'll steal some of your time to do the practice exam, maybe give it back with the abbreviated session 11. Okay, session 10, so this is part A. I'm going to try to even do something a little different. I'm going to split it up into smaller segments. In the past, they've been something like 15 to 35 minutes. I'm going to see if I can get that down to 10 to 20 minutes per part. Okay, so let's start off. The book talks about the difference between an accounting profit and an economic profit. And the key difference is that an accounting profit only considers, they both treat revenue the same, but with an accounting profit, you only look at monetary things as costs, whereas with an economic profit, you look at monetary costs and also opportunity costs. Okay, I think the best way to explain all that is just to give an example. And so be sure to look at the book's example. I can't remember now what the substantive example was. But anyway, I'm going to give a different one. The simplest one I can think of would be an industry for piano lessons. Okay, suppose that you have opened up a business giving piano lessons, and suppose in your business that your total revenue per month equals $5,000. Okay. Next, let's assume that to do these piano lessons, you rent out some office space and you use that office as a studio, say some small office in some building, and the rent for that office is $2,000 per month. Equals $2,000. And then to do, okay, so I'm going to say it's a piano lessons. Let's assume that the costs of a piano are zero, that that pianos grow on trees and the cost of a piano is zero, so we don't have to worry about. So I said economists assume we have a can opener, so assume that the cost of pianos is zero. They're so prevalent that we don't have to worry about those. I want to keep this example as simple as I can. But we do have to hire a piano teacher. Suppose you're the entrepreneur, you don't know how to play piano, so the cost of the wage for piano teacher equals $2,500 per month. Okay. Now, the way I've set this up, there are no opportunity costs. So actually, in this case, the accounting profit and the economic profit are the same. Let's wait a second before I actually talk about economic profit, but let's just give the accounting profit. So accounting profit, that just equals revenue minus monetary costs. Okay, so in this case, it just equals 5,000 minus 2,000 minus 2,500. And that equals 500. So $500 per month would be your accounting profit. And it turns out if you had to, when you pay taxes, this is what you would have to report to the IRS. And you would pay taxes on that $500. But now, let's assume, I might do this in red. Let's assume that now, instead, for the red case, you own office space or some studio. So you own a studio, which means you don't have to pay that rent. So you own it and it's completely paid off, let's assume. Second, okay, so that's one difference. So that means the rent is now zero. Okay. Second, let's assume that you can play the piano. You don't need to hire a teacher. So instead, you can do it yourself. Okay. If this were the case, now the wages you have to pay for a piano teacher is zero. And so what we would say now is that the accounting profit has changed. So you still get the same revenue, 5,000, but now the rent is zero and the wages are zero. So the profit is now $5,000. The accounting profit is now $5,000 instead of $500. Okay, now that's the way an accountant would look at it, and I think if you paid your taxes, maybe there's a way you could get a deduction somehow for the home office space. It's hard to say, hey, IRS, my taxes should be less because I didn't have to pay the wages of an instructor. I think you would still pay taxes on that 5,000 now. Okay, that's the accounting profit. So now let's look though at so the green. We're going to still maintain these assumptions. Okay, the assumptions in red. Okay, but now we're going to look at the economic profit. And this is revenue minus monetary costs minus opportunity costs. Okay. Okay. So now what happens with economic profit? The revenue is still the same, $5,000. The monetary costs, we're still assuming the red assumptions. So we own the office space. We don't have to hire a piano teacher. I'm the entrepreneur. So the monetary costs are zero. But what are the opportunity costs? Okay, let's think about this. So the opportunity costs are I'm using my office space for the piano lessons, whereas instead I could have rented that out on the open market. Some other entrepreneur have the other entrepreneur pay me $2,000 a month. Okay, I'm not getting that money. So by doing these piano lessons, there's an opportunity cost of not renting out that office space. That's a cost to me of $2,000. Okay. Then second, there's an opportunity cost of my own time. So I'm instead, but before I was paying a piano teacher to do these lessons, now I'm doing it. And instead, I could have used my time to do something else. And let's say that my wage is such that I could have done some other job and gotten $2,500 per month during that time. Okay, maybe that's a big assumption. Maybe I should have changed the numbers slightly, but let's assume it's the same. That I could have done something like been a waiter or something, and I could have, during that time, instead, I could have made $2,500 rather than devoting my time to a piano lesson. So that $2,500 that I don't get from being a waiter, that's an opportunity cost. So that's 2,500, and so here again, we'd call the economic profit only $500 when we add in the opportunity costs. Okay, so that's the key thing. Okay, we're going to have two different definitions of profit. Okay, usually when economists say the word profit, they mean economic profit. Okay, I'll try to be careful and actually say that word rather than as opposed to accounting profit. Okay, so that good. I was it's 11 minutes, so that's part A. See you in part B.